This is Practical Pivots, this podcast for startup leaders, founders, and investors asking, what do we do next? Join me for sharp conversations with an eclectic cast of experts to guide companies to disrupt the undisruptible, turn setbacks into scale-ups, and transform plateaus into pivots. Today, I'm talking with Adam Burrows, a longtime startup operator turned early-stage investor, and someone I had the pleasure of working with as my board member for Verblio for many, many years. Before launching Range Ventures, now one of the most active early-stage funds in Colorado, Adam spent years inside Home Advisor, where he led corporate development and ran several of their acquisitions. So he's seen startups from every angle, vetting them, acquiring them, managing them, and now backing them. In this conversation, we get into the real levers behind startup success, what founders often get wrong about investors, the current state of early-stage funding, both nationally and here in Colorado, and what he's learned from years of working with scrappy, high-growth teams. Here's my conversation with Adam. Adam Burrows, welcome to Practical Pivots.
Hey, thanks, Steve. Super happy to be here.
All right, let's start right in it. You've sat in the operator seat, the acquirer seat, the board seat, and for many years now, as the investor seat as well. What's the through line for spotting companies you know you want to invest in and work with?
Yeah, well, we invest really early. We invest at the seed stage and even pre-seed. So anywhere from somebody who literally just has an idea, although that's rare and a very high bar, to usually companies that have a few $100,000 of annualized revenue. That's the sweet spot for us. So we invest early. And so at that point, more than anything, it's about the founder. Okay. And what we look for in founder, we could talk the whole time about this, but at a really high level, I look for people who are have potential to be real outliers, right? They are obsessed about what they're doing. They usually have unique knowledge that gives them that obsession about whatever problem they're trying to solve. And they clearly have some characteristics, some ability that is outlier good, right? They're an amazing public speaker. They're an amazing team manager. They're an amazing programmer. There's something where they just jump off the charts. Now, obviously, that's going to come with some downsides too, as all of our greatest strengths can also be our kryptonite. But at a high level, those are the things that always jump off the page in the successful companies we like to back.
Cool. We could talk about this for an entire hour. So let's talk for at least a few more minutes.
Sure.
So I found in my experience that the more you know about something, the harder it is to actually extrapolate it and explain it to mere mortals. How do you work through the obsessive nature of knowing all of the details and their ability to actually communicate it towards you as you evaluate these companies?
It's a great question, and it's table stakes. If I get off with a call with a founder and I don't immediately understand what they're doing, it's a no. And I used to question myself, right? When I first started as an investor, you'd meet a founder who's clearly brilliant, knows all the ins and outs of what they're doing, and you get off a call and you say, I don't understand what they're doing. Right? I really don't understand. It must be me. They must be so smart that I just don't get it. Right. And maybe I should go spend time really digging in and understanding it. And after talking to a lot of people and learning this the hard way, I realized, okay, well, maybe I'm not the smartest person in the world, but I'm smart enough. And in order for this company to succeed, they're going to have to explain what they're doing and sell to lots of people who are, around the same level of intelligence I am, or maybe even less, for customers, for employees, for future investors. And so you have to be able to dumb down whatever you're doing and explain it to mere mortals.
What do you do differently? If this has been your approach for 5 years now, what are some of the mistakes you made along the way, and what are some of the tweaks you've made in your approach to figure out who are these early stage founders?
Oh man, Steve, it's a great question. Well, that's one, right? So really understanding what you see is what you get. I wrote a blog post about this actually, and there's a football reference for those that are big NFL fans, and you see who in your audience picks this up. But the title of the blog post is "They Are Who We Thought They Were." Mm-hmm. And there's a football reference there. That's where that quote originated. But what it means in this context is, however a founder acts in the interaction, in the pitches that we're getting, in the diligence, and how we act to that founder, that's how we both should expect the other person to act post-investment. Okay? Sounds obvious, right? It's just like people say about marriage, about any relationship you're entering into. Don't expect the other person to change dramatically from what you're seeing now. But there's the incentives to make you want to believe they can, right? You meet a founder early on. You love the business idea. You love what they're doing. the founder has some questionable things that they've shown in the process, right? Oh, maybe they didn't get back to you very quickly on something. Maybe some of the data was a little weird, but oh my gosh, it'll be fine. We'll help them. We'll coach them. It'll be great. We've made certainly a mistake we've made is making one or two investments early on that follow that template. Wish we didn't do it. And I've seen founders do the same thing with investors, by the way, right? I've heard this investor is amazing, right? This investor, they have a great reputation. Yeah, they're kind of stringing me along. Yeah, they're kind of jerks, now, but they'll be so great. I've heard they're awesome. Right. And then they take the money and they regret it forever.
God, that sounds familiar. All right. This isn't about my past mistakes.
Well, hey, these are truisms, right? These are truisms that if you do this long enough, you're going to make the same mistake.
So when a lot of investors kind of at larger stage or investment firms talk about we invest in the people, we invest in the team instead of the product, often as far as I understand, they're often talking about the track record. Like these founders, this team has already done a bunch of things before. They built $100 million, blah, blah, blah. How is that relevant in the early founder stage investing realm that you're in?
Yeah. So when you're underwriting a founder, you're looking at the preponderance of the evidence to get you conviction that this person could be an extraordinary person, right? So there's a lot of things that go into that, nothing of which is dispositive. And certainly the most risk mitigating thing somebody could have done is I did this exact same thing before successfully, right? So certainly track record is at the top of the list because you have to suspend less belief as an investor that they can actually go do this successfully. They already have, right? But most people don't fit that mold. Most people are first-time founders, or maybe they've had a little bit of success before and they're going for it again to go for something bigger. So then, and that's most people we meet. Then it's really about looking at things to try to find out, key attributes that'll lead you to be successful. One of the quotes my partner says, and I don't know where he got it, but I think is true as well, is winners are going to win. And what that means is, hey, maybe you never had a successful company, but were you successful at things that you tried to do that were difficult in the past, right? And I do tend to see this, that people that are successful at whatever it is tend to be successful at the next thing because they have the raw attributes of work ethic, of tenacity, of creativity to make something as successful. Again, nothing's dispositive, but that's one thing. Another thing we look at is, can you attract really impressive people around you? That's another aspect. Hey, you've built a team or you have some initial advisors or whatnot. Are these people that really looks like you're punching above your weight, right? How did you get these people on your team? Wow, they're really impressive. That is another factor we look at to say, hey, maybe you've never done this again, but you've got the signs that you might be able to do it.
I like that. All right. Before all of us have to go look up where this quote came from, where's the quote from?
I'm not sure.
Oh, no, sorry. In your blog post.
Sorry. The quote my blog, I thought you meant the winners are going to win. Okay. You want to ask it again? Sorry.
Yes, I do. Sorry. What the hell's the quote?
It was we are who we thought they were. No, okay. they are who we thought they were. They are who we thought they were.
All right. Before we all have to go look up this quote, they are who they thought that we were, or who we thought they were. Where does the quote come from?
It comes from, so I'm a long-suffering Chicago Bears fan, and there's a famous NFL game where Denny Green, this is maybe 15 years ago now, I'm getting old, who was the coach of the Arizona Cardinals, played the Bears. They lost in a very embarrassing fashion, and after the game, he had a press conference tirade where he said, they are who we thought they were, right? They're a terrible offense. They had a great defense, and we totally gave into it and lost.
That's great. I love that. That's for my own entertainment because my producer does not like sports references and she cuts every one of them that I say. So
you can go on YouTube. It's you don't just have to be a Bears fan to enjoy the post-game tirade that Denny Green goes on.
I am so I'm super interested when you're in the interview process, when you're the interviewee, the person who's interviewing you has already seen 20 people give the same responses and you have no idea what else anybody else says, but you are kind of part of a pattern for the interviewer. What are some of the worst things that you could possibly say that as a founder trying to raise money at early stage that they have no idea that they're making the same mistake others make?
Ooh, I love this question. So one of the things I think comes to mind immediately is you'll see founders that have, I don't know, one, two, three customers, and they said, okay, we've achieved product market fit. I love your optimism, but you got a long way to go to really achieve product market fit. Okay. I think another thing, and this is one of the big mistakes I see in people putting together decks, and really founders thinking very myopically. You've got to zoom out and say, hey, here's an investor who's not living in the trees all day long. They're looking at the forest. They're looking at forests all over the place. I'm living in the trees. And what this manifests as, Steve, is so many startups have the classic slide they're told to have, which is the competitive set. It's a competitive matrix, and it's our company and then the 4 other companies listed, and then here are the attributes, right? And too often I see there's like 4 companies listed who all I've never heard of and maybe are like fledgling or unsuccessful in their own right. Okay. And 2, the features that the company that's pitching obviously checks all the boxes. The other companies check some of the boxes. They're features that are like super micro features. Okay. If you zoom out and really what I care about is how are you going to build $1 billion company? The fact that you have custom headers and the other company doesn't have custom headers, I'm sure when you're pitching customers, they care. That's not going to be the determinative factor of whether you build $1 billion company or not and beat the competitor and become the industry leader. So that's something I see founders do a lot because they're in the weeds selling all day long and scrapping it out. You've got to be able to figure out a way to zoom out and figure out what really matters to people who don't know as much about your industry as you do.
I'm gonna geek out a little bit on this whole early stage part because I think I know so much less about this than other stages. So you guys write this check. The companies are just starting. Maybe their product is you've just given us a picture, but maybe you can give us paint that picture a little bit more. Where do you recommend they spend this check, and how long does it take to actually see that start to blossom?
Yeah, so it really depends at what stage we invest. So we will invest pre-seed, what that means to me is you don't really have revenue yet or a customer. You might not even have a product. So that's rare for us. That's usually when we have super high conviction in the founder because we've known them for years or the space or whatnot. And then it's about, hey, you taking this check to go build the product and get your initial customers. More often for us, Steve, it is a company that already has some traction. They've got a few $100,000 of revenue. And it's, hey, how can we take this money, pour fuel on the fire, certainly enhance the product, but really it's going to be about more than anything, building out go-to-market and getting, from a few $100,000 of annualized revenue to multiple millions such that you can go out and raise that next round of financing, usually a Series A.
Is this about hiring additional people or just funding the existing team so they can keep going?
Usually about hiring additional people. Usually there's, 1 to 3 key seniorish level hires that you're going to make as part of the round.
Got it. When does the revenue person, the outside revenue guru, come into play?
Depends on the company and depends on the strength of the founder. So if you have a sales-led founder or go-to-market focused founder, that senior person is probably not going to come in until about a Series A. If you have a more technical or product-focused founder, that could be that one first executive level hire that comes in at the seed round. So, at this stage, everything is pretty bespoke. And depending upon, if you have a team of 3 when we're investing, who that 4th person is going to be is, not something that's standardized whatsoever. It really just comes down to the strength of the other folks on the team.
If you were gonna allocate the skills that it takes to be an early stage investor into a pie chart, what % of that would be psychology versus business versus any other aspect?
That's a great question as well, Steve. I got to think about that. I would say you've got to be someone who can balance a million things at one time is the most important, because we have to be meeting with lots of different companies. So I need to know a little bit about everything and keep things straight. We're also pitching to our LPs, right? And managing our LPs who are our investors in our fund. And then broader community things, we're always meeting with candidates for our portfolio companies to hire. So you have to be comfortable with having 100 balls in the air at any given time. You also have to be, I would say, being an extrovert is very helpful. Because you're having to enjoy meeting with all of these people. So yeah, I think those are the 2 biggest qualities I would say. And then the third would be you've got to figure, and this is something you can learn, and I've had to learn, you've got to figure out how to say no the right way. because we say no to companies 98, 99% of the time. And that has, art more than a science. And I think I've gotten pretty good at that, although that was something that I struggled with early on.
Oh, show us. Give us the spiel.
Yeah. Well, I think it's hard because I respect the heck out of everybody who is pitching us or any other investor, right? It is not easy to go take the risk and start a company and pour everything into it. And I know how incredibly hard, stressful, emotional it is. And you're going to pitch an investor, because we do the same thing, right? We pitch investors. We had this idea of range and we went out and pitched investors. I know exactly how exhausting that is and everything. So I respect all these people. And so, you feel bad, especially you like them, you want them to succeed so badly. And it's so hard to say no. You also don't want them, you want to make sure, because a lot of founders take it personally, and they should, even though it's not, that when I say no to you, it's not me saying you're going to fail, right? I don't have you're going to succeed or you're going to fail, and that's the bet I'm making this early on. No, it's more about how do I idiosyncratically, with very little data, get to the subjective level of conviction I need to. So I'm saying, hey, if I'm going to invest, I have a high conviction that I think this thing could be successful. If I say no, I may have yeah, it could be, might be, I have moderate conviction, but that's a no, right? That's a no. And I think trying to communicate that to founders. So Steve, like anything else in life, comes down to, it's basic. It's the golden rule. Treat others how you want to be treated. If I'm in that seat, and I am when we're pitching range, how do I want to be treated? I want the person who says no to me to be transparent, honest, quick with their answer, and just and show respect and empathy for what I'm doing. And that's what we do, right? And if in the course of our conversation there's something else, maybe they could help me out with that we talked about, that's not about funding my fund or us funding their company, happy to do it. Happy to do it genuinely. It's the classic VC trope of the quote, "How can I help?" Right? And then and then the person asks them to help, and they just ghost the VC, ghost them. You got to be legit. You actually got to follow through. Do it. If you offer to help and someone takes you up on it, you got to help them.
I like that. That was a much better response than like the dating breakup. I'm just not feeling the vibe, not feeling the spark.
Yeah, and I just don't like the discount. The hardest part, Steve, is when the reason we say no to a company is because we're just like, founder just not that impressive. Yeah. Right? Very easy to say, hey, we don't believe in your market. Hey, we're not sure about the customer acquisition potential in this space. But when you're like, the founder just wasn't that impressive, or we just didn't vibe for whatever reason, that's where it's the hardest to be super honest. But we try to give constructive feedback as much as we can in transparency.
That's super interesting. All right, let me ask you a follow-up question. So as part of what I am consulting on now, I talk to a lot of companies that have been through a fundraising round where they went out and tried to raise with dozens, hundreds of investors and got squashed. And so the answer, the reasons that they got got denied can range from anything, but none of them include that the founder was not seen as credible by the investor. Is there a way I can dig into that and actually figure out if it's there?
Oh, it's such a great question. Certainly, if you could back channel with the investors. This is just such a hard one, right? It's such a hard one because again, it's this tension between, we all want to be nice, right? And we all know that if I say no to somebody and they come back and they're like, hey, I built the next Facebook, I'd be like, great, right? Great. Like, that's part of what I do, is we're going to not pick all the winners, and I want everybody to succeed. So you don't want to take anybody down or hurt anybody's confidence, but you also want to be constructive. Super hard. I think the only thing you got to do is back channel, Steve. I think the other way to ask is, the founder can certainly try to follow up with the investor and say, hey, is there something I could be doing better? Or welcome that, right? That's one of those things that if the founder specifically asks, hey, is it me? Is there something I could be doing better? And I really want to know, and I'm not offended, you're helping me by doing that. I think people will give the true answer, right? If they know it's a safe and welcomed type of feedback, they'll do it.
Sorry, dramatic pause. So I write all that down.
And by the way, now that I'm thinking about it, I have done that. I have had founders say to me, hey, is it something that we're doing? Is there something I could do better? And I've said things like, hey, yeah, you had the COO present. You're the CEO, and you stayed quiet the whole time, right? That's not a good sign for the company. The CEO needs to be the one. Maybe they need to be the CEO if they're the ones that are presenting, for example, right? Or hey, your team just doesn't have a ton of experience, and you come across as very clear that you don't have a lot of experience, right? Maybe you need to supplement your team with somebody who's got more things like that. I have said to people when they've asked for that type of feedback specifically.
So there's a common investment kind of Silicon Valley vibe that you're supposed to be as arrogant as possible when you walk in. And everything I'm hearing from you is you should be curious and vulnerable and confident at the same time.
Yes. Yeah, we've coined different terms here, but it's like the vulnerable arrogance or whatever. You want to strike that right balance, right? The arrogance or confidence needs to be there in terms of what you're doing, right? I have the utmost confidence that I am going to. My product is going to disrupt the whole podcast industry, and in 10 years, I know exactly what it's going to look like, Steve, and everybody will be doing it. We'll be doing podcasts the way that my product does it. And they'll be all using my product. And I'm 100% sure of it. And I'm not going to stop until that happens. That's where you should be arrogant and confident, right? Saying, I know exactly how to go do that. I don't need you. I don't need anybody, right? Like it's all about me. I've seen founders. That's where it goes too much in the part of arrogance, right? Your job as a founder is to be 1,000,000% confidence in your vision and your ability to realize that vision. But it's also, you're a resource aggregator, right? It's your job to get as many resources behind you and the company, both financial and advice and supporters and everything as possible. If anybody in your audience, another kind of esoteric reference, is a fan of Settlers of Catan. I use the analogy sometimes that a founder is like, you're playing Settlers of Catan and your job is to get as many resources as possible behind your endeavor.
Vulnerable arrogance. I'm going to keep that
arrogance.
All right. As Practical Pivots, we focus mostly on the go-to-market strategy, go-to-market pivot side of the house is where we generally focuses on larger companies, kind of ones that have hit the 5 to 10 million wall and have stalled and need reinvigorated growth. I'm wondering at the early stage, how much pivoting of the go-to-market strategy occurs, and how much do you stress to your founders that they have to keep trying the plan that they have because they haven't proven out yet versus they need to try something new?
Yeah, that's a really tough call of knowing when it's like, hey, you got to plow through and do it, or you just keep hitting your head against the same wall. Certainly at all stages, go-to-market continues to be, a challenge. You never know when you hit that first wall, whether it's at, 200K or 20 million. It happens all along the spectrum of when founders need to say, like we're not really getting anywhere anymore. I think I heard a quote. So there was a guy that used to work for me at a company I worked at, and he had worked at a number of startups, some successful, some that ultimately were super successful, including IPOs, some that had failed and flamed out. And I said to him, every startup and every company you're at, it always feels like a complete shit show when you're there, right? Everything's breaking all the time at every company you ever work at. Is there anything you can tell from the inside on those ones that went on to be successful and the ones that ended up flaming out? Is there any difference, or is it just kind of like haphazard luck? He said, no. Yes, it always feels like the sky is falling, everything's falling apart. But if you could write down every 2 weeks, what are the things that are falling apart? What are the hair on fire top 3 issues? If they're the same thing every 2 weeks, you're screwed. You got to try something completely different, right? If it's different things every 2 weeks, you're moving in the right direction.
By definition, startups are under-resourced, have people who have never done it before, don't have enough resources to cover every aspect of it in no time, and they're trying to disrupt a company that has already been doing it for years with all of the advantages. So it feels like, when I think about it, we're structurally set up this way, and the only 2 possibilities to actually succeed are, 1, you have a product that stands out so much that it just blows everything else away and you can be as dumb as possible and it still works, which is like, 1 out of 100.
How about 1 out of a million on that one, Steve?
Perfect. Perfect. And the other is you just have a team that will figure out something and it's not what you're going to start with.
That's way, way, way more common.
One of my favorite things about you is you are a very irreverent individual who does not follow the herd in any aspect whatsoever. What are some of your most contrarian points of view, after all of these years of experience in all the different directions?
Thanks, Steve. If you couldn't tell by my randomly quoting 2009 football post-game press conference and then a German board game in the first 20 minutes, I think that's fair to call me irreverent in some respects. Contrarian views. Yeah, with regard to startup investing, it's an interesting paradox that we face because as a seed investor, I know that to have the biggest outsized returns, you've got to be contrarian and right? You've got to identify the thing that is not obvious and everyone else thinks is impossible before everyone else recognizes, oh yeah, of course this was going to be a thing. But you have to balance that with the fact of if we are too contrarian, right, and it takes a little bit too long, there's no follow-on money for those companies because everybody else still says no. And then that company's out of business, even if we were to be right, years later. And so we can't be like too contrarian when it comes to early stage bet, but we definitely try to be on the more contrarian side of things. Just want to give that context. So one thing that I think is a little bit contrarian, maybe this sounds, again, these things sound obvious, but I see in practice they're not. And I think one is people in early stage investing severely underestimate the chasm between an idea or proof of concept or pilot and actual revenue from a customer that signed a contract with you, right? I just think when people attribute value to startups and funding and valuations and whatnot, they think, oh yeah, that step is a pretty easy step. And I've just seen so many companies literally just like, that is a big chasm to cross. That's one. I think another one is I am definitely on the side more of entry price matters. So this is a big and forever debate in the VC industry. The people on the other side of what I view would say, hey, this is a power law industry, which means we're just trying to hit a grand slam home run. And who cares what price you would have paid for Uber, right? If you could have gotten in Uber, doesn't matter what price you would have paid. Why would you, haggle over the entry price at all? That's right after the fact. But at the time when you're making the investment, if you were to say take that to the logical conclusion, hey, I'll pay any price for anything, right? We all know, everybody say, well, that's dumb. You're not going to have a successful investment and you'll pay any price for anything. So then everybody by definition has some price that they are willing to pay. And I've just seen this so many times that if you pay way too high of a price, you're pricing the company for perfection. And that's when I mentioned to you before that the product is just so good, it's the straight shot to the moon. That's 1 in a million. Lots and lots of successful companies, most successful companies, have some hiccups along the way. And if you invest at too high of a price or you founder raise too high of a price, it can be really hard to get out from under that and allow yourself a hiccup, right? I'll give you an example. If you're a seed stage company and you raise money at a $6 million valuation versus you raise at a $25 million valuation. Well, the $25 million one, hey, that person celebrated, it's great. Let's say it takes a little bit longer to get things going and then you finally get it going. You go out to market, okay, I've used that money. I raised the $25 million valuation. You go to market, the market says, hey, this is interesting what you've got, but like, it's been a couple of years already. You've got $200,000 of revenue, 25 million. We can't do that. We can't do that anymore. We just won't do it. It's not like a stock where I'll buy the stock at a lower price. Nobody's going to want to invest. Nobody wants to do a restructured down round and you're out of business. The $6 million company, like, great. Okay. Maybe you're worth 8 now. Maybe you're worth 9. You've still got life and you're still going and you're going in the right direction. So it gives you a lot more optionality. So I think price really does matter. Obviously, founders don't want to be diluted anymore than they have to. But I think being circumspect about that and trying to strike the right balance is very important.
Let's go into Nostradamus corner. So we are in one of the funkiest investment times, and you are at a super young fund as you're going through it. I would love to get your kind of description of where the current investor process is and where you see things going, both where you see them going and where you hope they might go instead.
Yeah, great question as well. So AI is everything right now, and it's for good reason. For good reason, right? This isn't Web3. If anybody knows what that was back in 2021, that we were not a buyer of. It was kind of hyping all crypto coins and blockchain being the future of everything. That was all hype and kind of fizzled out, and everybody lost their money on that. This is real. AI is real. There are huge businesses being built on it today. It is a world-changing technology and paradox and phase shift. That said, what people always do, in my opinion, is they tend to overdo it. And so we've seen a handful of amazing, companies that have grown and be faster and bigger than ever before. Cursor, Lovable, OpenAI, right? And because of that, VCs are like, ooh, I want to get the next one. And so what they're doing is anything that even has a whiff of an amazing team doing some cutting edge AI thing, we're in at any price. I think that is going to lead to a lot of zeros and a lot of lost money. Now, the opportunity is at the expense of that, right? What's happening is companies that are actually, everybody's using AI in their company somehow, but they're not AI first. Companies that aren't AI first technology companies that are selling some sort of software product or fintech that are getting amazing traction with customers that are growing really, really well cash efficiently. Well, it's not super hot AI. They're not going to go from 0 to 100 million revenue in 2 years. They're having a hard time getting funded. And I do think ultimately things get back to reasonable, hype and froth fades. And I think in a few years, some of these AI companies where people were willing to pay any price before they had any proof, sure, there'll be one or two that are huge winners, but 99% are going to be duds. And these other companies, I think, where you're getting investors are able to get incredible prices relative to the traction and real customer love that these companies are getting, are going to be in vogue again. And investors, that's a little bit of a contrarian view right now.
Excellent. Adam, is there anything else we haven't covered today that you want to make sure we cover before we leave?
No, I mean, I just have to, in my role, always give a plug for the Colorado tech community, Steve. We're 80% of what we do is invest in Colorado companies. And this just continues to be an amazing and I think underappreciated ecosystem. Just the talent that has moved here, that's grown up here. Every day I have to pinch myself with how lucky we are to be part of this ecosystem with so many nice people and also so much unbelievable and ambitious talent across everything from software to deep tech and biotech and everything in between. So anybody in your audience who's not in Colorado, you want to come out here, you want to move out here, you want to bring your company out here, give me a shout, adam@range.vc.
Perfect. Adam Burrows, thanks so much for being on Practical Pivots.
Thank you, Steve. Really enjoyed it.